Okay, we are live. And okay, and then there's usually a little bit of delay with comments. I don't know if have you seen that before? So
yes,
as comments come in, we may be a little delayed, but that's okay. Perfect. So welcome everybody. It's 12 o'clock on Thursday, July 30th. I've got Nikki Rohloff with me. Thank you for joining me, Nikki.
Of course. Thanks for having me.
You're welcome. So this will be recorded, so I just do the intro at first, but then I'm going to wait just a few minutes for people to hop on. Perfect. And because we can see, it looks like one person has already joined us. So I'll maybe wait just a couple more minutes for people to get on, and then we'll go from there. And then people will hop on, I'm sure, as we continue, because we'll be on for, 45 minutes-ish.
Sounds good.
It's Sarah. Okay, Sarah says hello. Hi, Sarah. How are you?
Hi, Sarah.
And then I've got Sarah. Okay, perfect. And then I was telling Nikki before we were testing this out that I may have children in the background who may interrupt. So forgive me. They should know, but not always. So we'll just wait a couple more minutes, and then we'll hop on. And even if no questions pop up, we'll just go over our agenda. And Nikki, you and I, we can share this with our clients after, because I think it'll be very valuable. That you can send out the recorded version of it. So
nice.
What else? That's it. I don't have anything else to talk while we're waiting for people. Just making sure that, and then Sarah can let us, I think she's viewing us. Oh, we got a few more people. Excellent. So I've got like 3, so we may as well get started because it's just a couple minutes after noon, and then people can continue to view, and join us as we start. Yes. So, all right, I'll do the intro again. So I've got Nikki Rohloff with me. She's a partner at Roach Associates, and they do tax planning, and you do more than accounting. It's more tax planning and strategic planning for businesses. And you are based out of Woodbury.
Correct.
And so so that's what you currently have. And we know each other actually through NABO, National Association of Women Business Owners. So that's how Nikki and I know each other. And I've used Nikki's expertise for my clients and referred a couple of people over to her. I don't know if any of them have actually, the follow through isn't always the best, because who wants to talk about taxes?
Nobody wants to talk about taxes.
Yeah, but today we're talking about it. It's very relevant, especially with the stimulus package. So we'll talk about that. And then I own Strategic Visionaries Financial Planning. So we do fee-based financial planning. I do consulting for both individuals and businesses. And it's really just about creating a life plan with your money and making your money support you and your values. So that is just an introduction of Nikki and myself. And if anyone has any questions, feel free to type them into the comments or say hello so we know who's here. And we're live on both YouTube and Facebook right now. And I will go through the outline for just some of the topics we're going to cover today. So we're going to do an overview of the stimulus package that was provided to business owners and individuals, because those were 2 different things. We also want to talk about what you need to know about the taxes on those stimulus packages. More specifically for businesses, it's the PPP and then the EIDL, 2 different loans. The PPP is forgivable, so talk about those. And a portion of the EIDL is forgivable, so we'll talk about that. And then what's taxed on those. And then we'll talk about what can you use that money for, and how can we make sure it's forgiven. What are the rules around the expenses? Can you deduct the expenses you use for it? So all of that jazz. So that's what we will discuss today. Is there anything that I'm missing, Nikki?
I don't think so. Looking over stuff. No, I think that was pretty much everything.
Okay, excellent. So why don't we just talk about just the overview of what was provided, and we'll go from there.
Perfect.
Through the stimulus and CARES Act.
Yes. So as I'm sure many of you know, with the CARES Act, there is definitely some not only benefits to help business owners, there's benefits for individuals, and then some actual tax law changes that affect prior year tax returns that people had filed. So one of the biggest things that we've been working on at the firm currently has been the PPP loans. We were actually very proactive, helped our clients. We filled out the applications for them. We connected them with bankers if they needed help. And then, as everyone typically knows, and how government works, everything kind of blew up, stuff changed. They added some different language to what the final regs are, or as they stand currently. And so we've been navigating and helping our clients navigate through what they need to do during this time. One of the biggest things that had happened was when they first came out with the stimulus package for the PPP funding, is they said the income would not be taxable to the business, which was great. We're like, okay, it's free money to be able to use to make sure your business is able to stay open, that you can keep your people employed, that you can keep that amazing staff and team you've built around your company. And then when they actually came out with the regs, they said, well, the income isn't taxable, but now the expense isn't deductible. There are a lot of organizations such as the AICPA, which is the American Institute of Certified Public Accountants. State societies are fighting this currently because of the fact of it was portrayed as being one thing, and then when it actually came to fruition was actually something different. So even though the income isn't taxable, wording is basically what it is, and it is taxable. Because now what's going to happen is if you got, say, $100,000 for the PPP funding, you have used it to pay payroll or rent. That $100,000 expense the business incurred is no longer tax deductible. So that's just basically saying, is another way to say it is the income is taxable since the expense is not deductible. Currently, that's one of the biggest challenges we're facing right now, is to how are these businesses going to pay tax on this, because businesses are hurting, and the fact of, you're now losing a deduction that you thought you were going to have. So a lot of lobbying is going on to try to fix that, to make it more that it is deductible, but we want our business owners to be aware of the fact to plan for it to not be deductible.
Right. Okay, so it's like you're planning for the worst, but
yes,
maybe it could be deductible. Yes,
but it's better.
Well, and I can understand.
Yes,
I can understand from the government why they wouldn't want you, because then they would want you to claim the loan, and then if you want to claim what you can deduct, right?
Yes.
So I can understand it, but these are extreme times.
Yes.
Clearly.
Yes.
And payroll, I understand, in order for the PPP to be forgiven, has to be a huge percentage of that. And if you can't, then does that imply that you couldn't write off any of your payroll expenses?
Correct. Anything that you use towards a loan, you would not be able to then write off. Which is also weird, because typically one of the main things that a business or that the IRS can use to substantiate is the fact that the W-3, which is what you report at year end showing all of your wages, ties to the business tax return. And now they're not going to tie, because you're going to have to take that part of that money back out of the deduction. Okay.
Got it. So I actually have another question about the PPP specifically. It was about the timing. There some discussion on you had to use it within a certain time frame. Is that still true?
So before it was 8 weeks. And then what had happened was the main point of the PPP was to get money to businesses that had been shut down by the government, such as restaurants, bars, salons, all that kind of stuff. And the problem was they gave them 8 weeks. But the funding started on the date you got the loan. So if you got the loan, a lot of them got them on like April 16th. Their 8 weeks started, but especially living in Minnesota, as we know, those were not allowed to be open. And so the problem was they got this money, but they wouldn't have been able to actually use it towards payroll, and you were stuck at how much you could use towards rent. So they have now extended it to a 24-week period to be able to use all the funds as necessary. So you don't have to take the full 24, but you can use it to run out your payroll.
Up to 24. Got it. And what about layoffs? So if they did layoffs, how does it work then?
So that was the intention of extending the time, because what had happened was they wanted the business owner to then pay the people to basically stay at home, or to have them come into work and sit there and do nothing. And in a way, they were putting the onus on the business owner that if you ask somebody to come back to work and they did not want to because of fear of getting sick, just everything that was going on, you were supposed to report them to unemployment and let them know that you offered their job back and they refused to take it. So that way they could not get unemployment. And so that else was kind of hurting business owners, because they're like, I see where they're coming from. I don't want to hurt them. I don't want to lose that staff in the future. And I think that was another part of why they pushed it out, was to be able to allow people to be home, especially with kids, different things like that. And then they can start using the loans once now stuff is more open.
Okay, got it. I have a question from Sarah. She says, what did the stimulus do for businesses besides just giving them money? Like, was there anything else, any other provisions that it provided to folks?
Yes. So the big ones were the ones having to do around the Families First Act. So this was protecting employees. This was kind of saying, typically you have to have 50 or more employees before you have to offer FMLA, before you have to offer sick time. And what this did was protect people to say, like, for instance, my business, we have 10 people here, so we don't have to offer FMLA or paid time off. But what it actually is doing is saying all business owners have to provide pay to the employees if they need to take off based off of that they have COVID, that their doctor is recommending they stay home because of it, or if they're taking care of a child, an elderly parent, a spouse who has COVID, that there are certain rates of pay that they can still receive. So that was a huge bonus for employees to be like, if I work for somewhere smaller, I'm not getting hurt in this to save and make sure the rest of the staff stays safe.
Wow, that's huge.
Yes.
I didn't realize that.
Yes. Some of the other stuff that have kind of helped people out was around retirement stuff, that you can now delay your RMD.
Yeah, that's huge. No RMD
a lot of people were super excited about that. And then some of the other stuff was around providing also credits for employers who continue to pay their staff when they are off of work as
tax
well.
Credits?
Yes.
Okay.
So directly against your payroll tax, so that way you don't have to remit less tax.
That's great. That's awesome. And then two, for this isn't my favorite benefit, but it is a benefit, is that they waived the 10% early withdrawal penalty from IRAs and 401ks, which I wish that people wouldn't do that, but sometimes they have to. So, but that did not eliminate the income taxes that people have to pay by withdrawing. So I think that's important, because people get confused about that. So if you make a withdrawal, there's no 10% penalty, but you still have to pay state and federal income taxes on those withdrawals. The taxes will never go away.
No. And that's kind of the issue too with the unemployment right now that people are receiving, is the federal unemployment and the state unemployment are both taxable as well. And so people tend to be under withheld on those amounts because they need it to get by right now. But just to be aware of that fact of, especially if you've compounded pulling out of your IRA, and then you're also been on unemployment, people need to be prepared that they might owe substantial amount of tax next year.
So the advice would be to make sure to save.
Yes. And to speak with your financial planner and to make sure that you are aware of what your tax liability is going to be.
That's right. Because with workers' comp, you don't have to pay taxes, but with unemployment,
you do. Yes.
So, yes, that's a really good point. What about, so we were talking a little bit before, and you said one thing that is important is to talk about, that cliff in regards to wages versus non-wage expenses. Can you speak to that?
Yes. The first time they came out with the act, it was going to be 75% was allotted for payroll costs. And that included benefits paid for employees, such as, putting away towards their retirement, health insurance, all that. So they had $100,000 max wage, which is divided over 52 weeks.
Mm-hmm.
But they could go over 100,000 per person if it was for additional benefits. Before, you were allowed to spend 75% of your cost towards wage, and you could use an additional 25% to pay towards rent and other utilities, mortgage, if the business owns a building, that kind of stuff. When they came out with the final regulations and extended it to 24 weeks, they made a change that was actually worse for people who have gotten the loan, that there is now a cliff. So whereas before you were allowed to take that 75%, and if you took that, you would just have some of it that was a little bit, that wouldn't be forgiven. If you use 30% towards payroll or towards rent and stuff like that. Now there's a cliff. And so if you do not use 60% of the amount for payroll cost, specific payroll cost, you will lose all of it being forgiven. Before, you would have had a staggered amount, and now it's like, yes, you use 50% towards rent, none of the amount is going to be forgiven, even if you use the other 50% towards payroll.
Got it. Okay. Well, that's interesting because but then they reduced the amount that you had to use towards payroll. Is that right?
Yeah.
Okay. Interesting. It's changed so much.
Yes. From what they first said to what is actually happening are two different things.
Yeah, totally. And then how do you substantiate your expenses in order to make sure that they are forgiven?
So what we've actually done is we built a spreadsheet. Accountants love spreadsheets, love spreadsheets. And actually, we have shared this not only with our clients, but people in our circles, people we've talked with. We've had quite a few referrals. And so if anybody on here is wanting a spreadsheet that's pretty easy to do, and it'll actually match exactly to the loan application when they get it, send me an email and I will gladly share it with you. We're trying to actually help people, so it's free of charge. I can walk you through it. But what you have to do is determine what your full-time equivalent people were. Make sure you're tracking that so you have the same amount of full-time equivalents by 12/31 of 2020. And then really right now what we're kind of telling people, since you have so much to be able to use towards payroll, if you can hit it towards payroll first, just track payroll reports. It's going to be the easiest thing to submit, the easiest to prove. If you need to use it towards rent, then also you need to show rent invoices. You'll probably have to provide your lease showing that you did have it in effect before 2/15 of 2020. We're kind of just telling people, don't even bother with the telephone. Don't bother with utilities. The amount of tracking it's going to take is just not worth it. It's
not worth it, especially since the period is so long that you can use the funds now. So, okay. And so again, Tanya asked, she says, can you repeat the forgiveness process one more time? So you get the funds, of course, we've already gotten the funds. And then what?
So once you have the funds, a lot of people have been wondering, do I need to switch to pay payroll out of that account? Can I just put it into my normal bank account?
Right.
We've just been advising people, put it in your normal bank account. It's so much hassle to switch around stuff. Move it into your normal bank account, wherever you pay payroll from. And then each week, every 2 weeks, however it is that you pay payroll, just print on that report, which you should be doing anyway, but just save it. And then that way you know exactly how much you've paid towards payroll, and then also keep your rent invoices that you get on a monthly basis. You're just going to be able to want to prove those two things. If you have to start proving other stuff, it's going to get a lot more detailed.
Right.
Currently, a lot of banks are not taking applications yet because they feel that there's likely going to be more changes. So most of the banks we are working with are not taking the applications. You have until, I think it's October 2021 to have it fully forgiven.
Oh, wow. Okay.
Which is huge. So it's kind of like the waiting game of seeing what's going to happen. But the big thing to track right now is what your full-time equivalent employees are. If you had to, let's say you had a staff of 10, you had to lay off 3 people, but you got that PPP funding based off of having 10 people. You're just going to want to make sure by 12/31 of 2020, you have made a good faith effort to get those people back on board. And let's say you have somebody that you knew you were temporarily laying off, you plan on bringing them back. They know you plan on bringing them back, and you call them in December and say, hey, we're ready for you to come back starting January 5th. And they tell you, you know what? this has been working much better. My spouse got another job. We're working things out. We can make it without it. So I'm not coming back.
Mm-hmm.
As a business owner, you will not be penalized for that person choosing not to come back.
Okay. Okay. So how do you, so then you would just have to document maybe the communication.
Yes. You would want to
don't
document
wanna
the
come back.
communication. You'd want to get something in writing from that person just
Yeah.
saying, I'm choosing not to come back at this
Yeah,
point.
that makes a lot. Okay, that makes sense. And then I have a lot of clients who are it's just them. They're self-employed, and then
Yep.
either they have 1099 employees, or so how does it work? First, let's just talk about if they have 1099, and then we can talk about just the simple this is solo. So what if they have 1099, they don't technically have W-2 employees? How does that work?
So technically their 1099 person would have also been able to file for the PPP loan.
Yep.
When they first came out, they said 1099s would be included in mine. Like if I filed for it, I can claim my 1099s. And then they came back and said, nope, that's actually not allowed. So if you had your funds based off of 1099 people, just know that you will likely have to pay that back.
Okay.
Because you cannot claim them.
Got it. Okay.
But we've had some people who applied for that before that ruling came out. And we've just said, use the money, because at a 1% interest rate, you really can't go wrong. So use the funds, just be prepared to pay it back once you need to.
Okay. Got it. That makes a lot of sense. So if you got the fund, because that changed, it sounds like.
Yes.
Okay. So just know that you'd have to pay it back. And then if you don't want to have to pay it back, then pay it back now, I suppose.
You can pay it back.
You can pay anything. There's no prepayment penalty.
Nope.
So you can pay back whatever you didn't use now if you didn't want to have to deal with it later. Okay. Tanya asks, what if you are ready to take them back, your employee or employees, but they want to stay on unemployment, but they don't want you to fill their job?
If they don't want you to fill their job and you need them back, you pretty much have to say, you need to come back, or I need to fill the job. Like I said, this is where they're putting the onus on the business owner to report this person, that if you've offered them their job and they won't come back because they want the federal unemployment, you are actually supposed to turn them in. I don't agree, because it's like, you don't want to burn a bridge with people, especially if they are a good employee. But if they're not back, and as a business owner, you need to move forward.
Yep.
I would say you terminate that person and give them the choice. Say, you know what, I have to make a business decision. I need to keep up and going. So I either need you to come back, or I'm going to have to find somebody. I cannot hold your position any longer.
Yep. Okay. Got it. That's good advice, because if they don't want you to fill the job, but you need the job filled, especially for the loan to be forgiven. I mean,
right. And
you don't really have a choice.
As much as the federal unemployment has been great, it's actually starting to now hurt business owners.
Yeah.
Because you can't get staff to come back. You can't hire because people are making more on unemployment, or just as much than they were working.
That did expire on Saturday, right?
It's supposed to. There is talk that they will extend it.
Oh gosh, I hope they don't do that.
I know, and that's kind of what a lot of people are lobbying for, because they're like, I can't hire people, so I can't keep my business.
Yeah, they're making more than what. Like, they're making more than what they were making before. So why would they? I wouldn't come. I wouldn't want to come back.
I know. I'm like, if I could stay home.
By making more by not working. That's crazy.
Yeah. So hopefully that it does end as of 7/31, in which case a lot of people would be willing to come back to work at that point.
Okay. Got it. Okay. And then let's talk about the more simple person who is self-employed and it's just them. They're a solopreneur. And they don't have a 1099. So they didn't get any type of loan for their 1099. They just got it for them as a 1099. So unless they're an S corp or something like that. So regardless of whether you're, you're just taking it as a sole proprietor or as an S corp, can you tell us about the expenses that you can pay for as an individual business owner, and it's just you? Yeah. Yes.
So they actually are treated two different ways, because an S corp has to take a wage.
That's true, because you have the W-2 income from there.
Yeah, because you have to take a wage. So let's talk about the single member. They file on their 1040.
Okay.
And so they would have gotten, I think the max you could have gotten was $20,800 based off of how they factored $100,000 payroll. The thing to be aware of is this was another one that they came out with after the fact of saying if whatever you reported for income last year is what you are going to make this year. So if you filed your tax return in April and said you made, nothing, you got your income down to zero, and this can be done very easily with tax depreciation, that you had a profit, but you're showing zero for tax. It's very common. But they are saying that none of that would be forgiven because technically you didn't have payroll.
Right. That makes sense.
So that has kind of hurt some people who did take it because they had already filed their tax return. If they would have known that, they would have done it because they wouldn't have taken the tax advantages they can.
Correct.
Currently, they have not came back and said, because before it was then saying, well, 15,000 can be used as a wage for that self-employed person. Now that they've extended it to 24 weeks, they have not came back and said, can you actually use that full 20,000? Because a lot of solopreneurs might work out of their home. So they don't really have rent. And so they're kind of like, well, can I use this for wage, or I'll write off my cell phone, my utilities, that kind of stuff. They have not stated yet if they are going to do that yet or not.
Okay.
I have been advising any clients that I have that did get it, physically cut yourself a check. Don't just transfer the bank account, even if you're banking at Wells Fargo. You have your business, you're checking. It's super easy to transfer money. Make a paper trail, cut yourself the check, deposit it into your personal checking account.
Sure. Okay.
The thing with, the place that self-employed people get really lucky is whether they made 100,000 and they took that full 100,000 out of the company or left it there, they get taxed the same. And so with them, they're not going to get taxed. They truly will not get taxed on this income that they get. So they're kind of those business owners that are self-employed are getting a bonus on that part of it. So that is a plus, but that's another thing they're bringing up of being like, well, why does this business get treated differently than this business who has wages? So that's why else they're trying to fight and say that that should not be penalized against business owners who pay a wage, not get that deducted.
Because you could be making the same thing as your neighbor business. And just because you filed differently,
But the big thing with how that pulls into retirement too is you do not want to put the 15 or the 20,000 that you got into income, because it's truly not income. It is a loan. So then you would want to make sure that you're not basing what you can max out for retirement. You do not want to factor that amount into there because it's not truly income.
But they can contribute it to retirement, right?
Yes.
So then wouldn't that be confusing because it's a deductible contribution to, let's say, your SEP IRA?
Yes. So it is one of those things that we're like, we need more clarity because what you've written and what we can do with it are not
two different. They're not communicating. No. Okay. No, I was like, oh wait, that doesn't make any sense. The whole benefit of doing a SEP IRA is that you are getting a write-off dollar for dollar, up to the 20 or 25%. So then you lose that. Interesting. Okay. I feel like I had, so from what I understood that you just said, for the people who are, let's just say, sole proprietor LLC, and they're not an S Corp, are you saying that it's still unclear what they're going to be able to write off right now? Okay.
Yeah, because if they go by the same thing that they treated business owners of saying, well, your employee can now take, rather than X dollars over the 8 weeks, you actually get to take more of their payroll. But they haven't specifically said that self-employed people can do that same thing. Right. They're still capped at the 15,000. I think it's 15,300. And they have not came back out and said that they can take the full 20,000 as payroll.
Okay. Got it. Okay. Well, and this is honestly, because any client that I meet who's not taking a wage, they're just declaring a loss, I encourage people to take some income. Because I'm sure you might do the same, because it benefits you in many ways. It allows you to contribute to retirement and take a deduction, because if you don't have wages, you can't contribute to retirement.
Right.
So it gives you a lot more privileges. You can't qualify for disability income if you don't have taxable income. So, and there's more, right? Life insurance and all these
Getting
other,
a loan, buying a house.
yes, qualifying for loans is huge. So whether it's in your business or personally. So I think taking the income, a little bit of income, this is a good lesson that we should take some income from our businesses.
Very much so.
Yeah. What else? We've talked about the forgiveness already. I'm looking at my notes. Talked about the cliff, about wage versus non-wage. Is there anything that, oh yeah, this is a good question that you brought up. Is there anything that people who are furloughed need to be aware of?
Oh yes, that was on talking about to make sure they're withholding enough money or planning for.
Oh, so for the unemployment, we had discussed that previously.
Yes.
Unemployment's taxable.
Yes.
Okay. Well, why don't we shift gears a little bit and talk about future planning? And we can talk about what today versus the future means. And that's even true because I've talked to a lot of clients who are holding more onto their cash. They're nervous about the market, but they're nervous about losing their jobs. A lot of different things at play. And I think there's a lot of anxiety, money anxiety, that's going on. I'm sure your clients probably feeling the same way.
Yes, they are.
So I wanted to talk about maybe tax consequences today, just really high level. Why don't we talk about the tax consequences today of like retirement funds versus in the future? And we talked very briefly. I just want to make sure that our viewers can understand the difference between like a SEP IRA, and maybe we could talk about that versus an IRA and a Roth, because learning about the tax treatment, would you speak to that a little bit, and just so that they could better understand?
Yes. So the SEP IRA is for business owners, or 1099s as well. Mm-hmm. And so with that, you're allowed to take a certain percentage of your of your net income and put that away, and you get a dollar for dollar deduction. It's a huge win. The other big plus of it is you can actually extend your tax return in April and wait until October of the following year for last year. So a lot of our clients do that more because they like to hold the money and be able to use it until it's due. They always know in the back of their head, okay, I'm going to have to pay X dollars in October, but they're using their funding right now. They're helping them build their business, do that kind of stuff. Yep. So with that, we always recommend, and the thing your CPA should be telling you, you should be working with both your CPA and your financial planner on this, but I can tell you what you will save dollar for dollar. I can say if you put $10,000 into your retirement account, some people are only going to save $1,000. Then you have to decide does that fit what I need for not right now? But if I tell you you're going to save $6,000 in tax, that's a no-brainer. Right. But I can't tell you where to invest it. I don't know what your long-term necessarily, are you doing a legacy fund? Are you wanting to pass on a charity? And so that I would pull Whitney in and say, here's what I'm thinking. Does this make sense to you? And then see the client, what they want to do as well. Yeah. So you get the deduction then. So you do pay tax on it when you are taking the money out in the future. So, and that is also how a traditional IRA works as well. You get the deduction now when you contribute to it. And then when you take money out later, you also have to pay tax on any of the gain that's in there. Right. The plus of the Roth is that you're putting in after-tax dollars. So you don't get a tax deduction right now, but when you pull it out later, hopefully it's growing. Hopefully you've invested well. You've had great financial advisors. So when you pull that money out later, it comes out tax-free. Right. And one of the things that we prep a lot of our clients for is like, I personally hope I make more money in retirement than I do now. My ultimate goal is that I continue to increase my wealth and not decrease it. So a Roth is a great thing to do. Right. In the current economy, we are actually advising a lot of our clients who have taken a hit business-wise, and so their income is down right now. So they might not be able to contribute as much if they were maxing out retirement before, is to take advantage of the low tax brackets and convert your traditional to a Roth in years like such as now. We're only going to have a 10 to 12% tax bracket. Okay, yep, that makes sense. And two, another thing to consider, I always talk to people about, it's not all or nothing. That's, I think, one thing that people always think, oh, I don't want to do the Roth because I don't get a write-off. I'm like,
Well, you can actually do a SEP IRA and a Roth in the same year. And maybe you don't max out the SEP if you don't have the cash flow to do it. So you could do a combination. But I always make sure that people know to have a balance, because if you get to retirement and you put all your money in, if you put all your money in pre-tax, then 100% of your income is going to be income taxable. So let's say you're taking 100, tax bracket 35, you only get $65,000 of income, right?
Correct.
Net income. But let's say that you have 50% in tax-free and then 50% in pre-tax, then you're only paying 35% on 50,000. And so then your net total income, 0.65. So then you're making 82,500, which instead of 65, and you're taking the same amount of withdrawal. So that's why it makes such a big difference, because you can then, like you had mentioned, Nikki, make your money last longer because you're paying less taxes. So it's very important to think about that now. And then, like you had said, if your income's lower, you could also do a conversion from an IRA to a Roth, because you're only going to have to pay taxes on, now it depends. One strategy that I actually use with my clients a lot, because you can't contribute to a Roth IRA directly.
Correct.
If you're above that income earning limit, which I always have to look at. And do you know what off the, is it, it's 100 and, yeah. Yes, it's phase out. Yep. So it's this is for 2020, single head of household. There's a phase out. If you're married, it's very high, actually. It's 196,000 if you're married jointly, 124,000 if you're single. So if you make above that, you can't contribute, or you can only partially contribute to a Roth. However, you can contribute to a traditional IRA. The maximum amount that you can do is 6,000, and then you can convert it to a Roth IRA after you make the contribution.
Yes.
And the idea is that you don't deduct that contribution to the IRA. It's a non-deductible contribution. So that's a really good strategy. If you don't have any tax-free money, good way to build it every year. It's a strategy that a lot of my clients implement who are above that earnings limit.
And you always want to talk to somebody. If somebody tells you, well, this is a great idea to do this year, you never want to look at a year in a silo. Like, it is one of those things of like, what happens next year? What happens 20 years down the road? You want to make sure you're making proactive decisions that are going to help you hit your end goal, and not just be only focused on what is this going to do to my checkbook today. Because if you are constantly making those kind of decisions, you're going to hinder what you could do with your wealth in the future.
Yep. It's refreshing to hear that from someone who does taxes. They always seem very interested in the tax savings today, and that's it. Yes. So no, it's that future part. And that's where it's good to team up with your financial advisor and accountant, even at the same time, just to make sure that you're aligned on your strategy with how you're saving towards retirement. And then there was another thing. Could you speak to, we didn't talk about this ahead of time, but I know there was a little bit of difference on how you could itemize your charitable deductions for this year that was in the CARES Act.
We haven't done a ton on that kind of stuff. Like, we've looked at, you would have the donor advised fund people have done. I can look up to see too. If it's affected 2020, we've actually been more focused on 2019 yet, and like looking at the net operating losses, like, because you can bring those back into prior years. But I'll be 100% honest, I have not looked into what the charitable is for 2020 under the CARES Act.
There was some type of provision. It's not very clear to me. That's also why I was curious if you had looked at it, but it did not seem very clear. And who knows, maybe they've changed it since they initially introduced it. But that's probably true. But I know there was something like you could add an additional deduction. It was something, like I said, that I was not very clear about. But it really seemed only relevant to high net worth individuals that itemize their charitable deductions and don't take the standard deduction, is what it seemed like to me.
Right. Because if you're better off itemizing, we've kind of prepped some people to be like, if you want to still get the tax deduction, like maybe donate in January of 2020 and then December of 2020 and then not do anything in 2021 is one way to do it. If you're really set on the deduction, but you have to make sure you're also close enough that it makes sense again. You don't want to just look at this year. You want to look at multiple years.
Right.
Other people have done the donor advised fund where they front load a whole bunch of money into it.
Yeah.
I'll be honest, every calculation we have ran over a 5-year term, if they typically did $20,000 a year and they took $100,000 deduction in 1 year, in 5 years, it does not make a tax difference. That actually is anything substantial.
Right. And if your income is increasing, then it might even make more sense to do it over a span of years because your limitation on deductions is based off of your adjusted gross income every year.
Yes. And so I did just look up the CARES Act, and that must be what they eliminated the cap of that 60%. So it is 100% of your AGI. So that's what they did.
Wow.
Yes.
That is crazy. So just to contextualize this for people who are watching, that's crazy. So you were, when you're doing a cash donation, because it's 50% for the others.
Non-cash. Yep.
Yeah, but for cash contributions, you were able, or charitable donations, you were able to deduct up to 60% of your adjusted gross income. So let's say you make $100,000 and you contribute, let's just call it $100,000 of cash towards a charity, a public charity. Then you were initially only able to deduct 60,000 of that in one single year. But then you could roll forward the rest of that deduction, the 40, for 5 years. However, now it looks like you, in one single year, you can write off that full $100,000 deduction.
Correct.
Wow.
And so this is great because usually what this happens is people who have retired early and they have built up that wealth and they are very charitably inclined, or they have the stock options. That's another big one. But to be able to take that deduction is usually, if you're hitting that, it's because you truly care about charity and not the tax deduction, but it is a huge benefit for those who have a low income year, but have other assets that they're using towards donation.
Wow. That's a great benefit. I didn't realize that. Wow. Okay. Well, in closing, maybe we could just talk a little bit about our process. I know this is something you and Nikki and I, we have in common about looking at, because I know we've talked a lot about taxes and money this whole time. Yeah. But it's really about what money does for you and what your core values are. So I know that's something that we both really focus on. So just to speak to a little bit, why don't, Nikki, you first talk a little bit about your process and how you work with your clients and how you tie in their money to their goals. Would you talk about that a little bit?
Our firm is not the traditional CPA firm. We actually are very proactive. We look, like I said, what's going to happen 5-10 years down the road, not just today. And with that, our big thing is life is too short. We want to work with clients we love and that want a long-term partnership with us. Not just, I don't want to just talk to you in April. I want to talk to you all year round. And so what we did is we got rid of the billable hour. So we do a fixed price partnership. We agree on what we're doing for you for an entire year. It's the same amount, monthly amount, budgeted out. But then with that, you can call me on the CARES Act. You can call me because you're stressed out about I've had so many phone calls with my clients of just being like, here's just one more step. Let's just take another step forward. Let's see what we can do today. And with that, like, we are way more invested then in our clients' future as well. And so we're helping them. We're coming alongside their financial planner, their lawyer, whoever it is, to make sure everybody's on the same page. And so we do, we only work with business owners because that's who we can truly help. And that's who we have a passion and a heart for. And then with that, we also do, I'm Berkman certified, which is a behavioral assessment. And so we actually give those to all of our new clients just to see, you know, what is your mind frame towards certain things, just so I can know how to come at it in a way that's going to speak to that person. Because just because I feel a certain way doesn't mean somebody else does. Or doing that kind of stuff. So we definitely do a more holistic approach to how we deal with our clients and how we work with them. So we joke because it's like we interview our clients just like we interview staff before we decide if we want to make a partnership with them. And we also joke that we're financial therapists because it's like, which I'm sure you feel the same way, Whitney. It's
totally.
like I have clients call me and they're like, I'm having an issue with a staff person. Can you talk to my spouse because they don't know where my next sale is coming from and why this is so important. And so we do those kind of things. We help between marriages, just talk with people about this is normal, especially dealing with serial entrepreneurs. They have their own mindsets.
Right. True story.
And just when you own a business, it can be really lonely. And so we come alongside and provide that guidance and that sounding board for people.
Yeah, absolutely. And that's where because I do that very same thing. And where we don't do billable hours. And I know a lot of people always the question is with financial advisors specifically is how do you get paid? Because it seems very confusing. So I like to make it very transparent. And so there's wealth management where, you pay a percentage fee based off of your portfolio, but that's not really, I'll do that. And because it's important to somebody's plan, but that's not really my passion. My passion is where we do the fee-based financial planning. It's a year by year where they can pay monthly or annually, whichever they prefer. And then it's all inclusive. There are service levels depending upon what they want provided to them. But that's something that we discuss, that we finalize before we start working together, just so that way I know exactly what they're looking to do and making sure that I can deliver on my promise and their expectations. So, and then there's unlimited access throughout the year, just like what you had mentioned. We meet more formally to review their financial plan that we've created, and we do that 1 to 3 times a year, depending upon the level. And then I have a specific business, so I don't necessarily just work with business owners, which Nikki, because a lot of this is personal financial planning for business owners, which is a little bit different. So I meet with the spouse a lot, and so that's fun. But doing the personal financial planning for business owners is some of the most important planning that they can do for themselves. So they make sure that they're set up for whatever that they want to achieve.
Right. And also, having those discussions, be like, what is your plan? Are you handing it to a child? Do you plan on selling? Because you can't wait until you're finished and say, I'm going to sell today, because there's so much legwork you should have done before that.
Yeah, exactly. And another thing too, is I don't do a personality assessment, although I really like that approach. I do the values approach where we sit down together. I have them complete an exercise and say, what are your values? What is most important to you? Because your values are reflected in where you spend your money and where you spend your time. So if I know what your values are, then I can better understand why you're spending your money how you are. Or maybe there's a mismatch between your values and your money. And that's a conversation that we have as well. So, and then constantly bringing up your values, because money is not really the most important thing. It's family or whatever adventure. Yes, your children, and that's why you want to fund college. Whatever it is. So I don't think there's anything else for us to discuss, technically speaking. Tanya says, this was awesome. I have to personally jump, but I hope some on my VIP group page were able to join and watch, or we'll see it playback later. Blessings to you both, amazing women in business. Thanks, Tanya.
Thank you.
Thank you. So like I said, this is on live, so it's been recorded, and we'll be able to distribute this to our clients if they would like to see it, or anyone that's interested. Nikki, I did put your email on the chat, so if anyone wants to email you for that spreadsheet, they can do that. I'm also going to get that spreadsheet from you. And then I believe that everything. Is there anything else that you wanted to add?
I don't think so.
Okay, excellent. Well, thank you everyone for joining us. It was a pleasure, and I look forward to next month. I don't have a speaker yet, but we will be doing another live next month. And Nikki, again, she is a rock star with Roach Associates, a partner, and then I am Whitney with Strategic Visionaries, the CEO.
Perfect.
Thanks,
Thank you,
everybody.
Whitney.
You're welcome. Talk to you soon.
Bye.